Welcome back to Entrepreneurial Edge. Today we're revealing where the world's smartest investors, think Warren Buffett and top hedge funds, are putting their money for 2025. Forget meme stocks and hype. We're talking about companies with proven, durable business models that quietly build empires and compound wealth. We'll break down the exact companies these financial titans are betting on, and why. If you want to learn how the best build lasting wealth, you're in the right place. Let's dive into the first power play. First up is Apple. Most see it as the iPhone company, but smart investors see a compounding machine. Apple relentlessly buys back its own shares, shrinking the share count and boosting your ownership, without you lifting a finger. With over $85 billion in cash and sky-high profits from both hardware and services, Apple's flywheel is unmatched. The real magic? The Apple ecosystem. Once you're in, you rarely leave. That loyalty is Apple's moat. This is why Buffett and hedge funds load up on Apple. They're not betting on the next gadget, they're betting on a business that turns profits into shareholder value year after year. Apple's not about hype. It's about compounding wealth, quietly and powerfully. That's why it's a foundational holding for the world's smartest investors. When you see the smart money buying Apple, they're buying a compounding engine. It's the math of wealth, not the noise of trends. Next up, another tech titan with a different playbook. Microsoft is the king of profit margins. With net margins over 35%, it's a cash machine. Its cloud business, Azure, is a recurring revenue powerhouse, while Office and Windows are the backbone of global business. Microsoft's products are so essential that companies can't easily switch, giving it immense pricing power and a wide moat. Unlike many tech giants, Microsoft funds growth with its own profits and keeps its balance sheet clean. Smart investors love this discipline. It means resilience in any market. When hedge funds buy Microsoft, they're buying a margin powerhouse with multiple dominant revenue streams. It's not just software, it's the toll road of modern business. Microsoft quietly collects its fee as the world runs on its infrastructure. That's why it's a core holding for the best investors. Now let's look at a fortress of stability. Johnson & Johnson is the definition of stability, a dividend tank. For over 60 years, J&DJ has raised its dividend through every crisis imaginable. Its strength comes from diversification, pharmaceuticals, medical devices, and consumer health. If one segment struggles, the others pick up the slack, making earnings reliable and predictable. Healthcare is always in demand, so JJ's revenue stays steady even in recessions. That's why conservative investors and pension funds love it. It's about safety and steady income. J&J isn't flashy, but it's built to last. It's a get-rich-for-sure stock, not a get-rich-quick one. Next, a company that profits every time you swipe your card. Visa is the toll booth of global commerce. Every time you pay with a Visa card, they take a tiny cut, no matter what you buy. With profit margins over 50%, Visa is one of the most profitable companies on earth. They don't lend money or take credit risk, they just run the payment network. As more transactions go digital, Visa's profits soar thanks to fixed costs and explosive scale. Their moat? The network effect. Billions of cardholders and millions of merchants reinforce each other, making it nearly impossible for new competitors. Visa and MasterCard form a duopoly that dominates payments worldwide. Visa returns mountains of cash to shareholders through buybacks and dividends. Smart money sees Visa as a bet on the unstoppable shift to digital payments. It's a license to print money every time someone makes a purchase. Now let's revisit a classic compounding machine. Coca-Cola is the original compounding machine and Buffett's favorite for a reason. Its brand is a global icon, giving it unmatched pricing power and customer loyalty. Coke steadily raises prices and passes on costs, keeping profits strong. It's a dividend aristocrat, increasing payouts for over 60 years. The business is simple. Coke sells concentrate to bottlers, letting partners handle the heavy lifting. This capital-light model means steady, predictable cash flow. Smart investors hold Coke for its durability and commitment to shareholders. In a world chasing the next big thing, Coca-Cola proves boring can be wildly profitable. It's the ultimate buy-and-hold stock. There you have it. Apple, Microsoft, Johnson & Johnson, Visa, and Coca-Cola, the core of the smart money playbook for 2025. The common thread: durability, consistency, and capital efficiency, not hype. These companies quietly compound wealth through earnings, dividends, and buybacks. This is how lasting wealth is built, patient ownership of world-class businesses. It's Buffett's strategy, and it still works. If you found this valuable, hit like and subscribe for more deep dives. Thanks for watching. See you next time.